have to have 20% down in order to buy a home. It's just a fact.
No, it's not.
If you don't have a 20% down payment saved up, it makes no sense to buy a home.
That's not true at all. One of the most common and long-standing myths in real estate is that you must have 20% saved up for a down payment in order to buy a home, and it's completely untrue. But if you've been holding off on buying a home because you don't have that kind of cash saved up, you might be missing out on the perfect home, and for no good reason. This idea that only smart or financially responsible buyers put 20% down has been floating around for decades. But here's the truth. You can buy a home with way less than that. And in some cases, you might actually be better off doing so. In this video, I'm going to break down exactly where that 20% rule myth comes from, why it's outdated, and how mortgage insurance actually works. And more importantly, I will show you how to run the numbers so you can make the smartest financial decision for your individual situation. We're going to talk about the pros and the cons, the trade-offs, and why putting 20% down might sound smart, but could be costing you tens of thousands of dollars. If you're buying a home this year, or even just thinking about it, stick around because this is a video that you should watch. So let's get into it. All right, so if putting 20% down isn't actually required, where did this idea come from? Why does everyone, from your uncle at Thanksgiving or the hundreds of finance and real estate YouTubers, keep repeating it like it's gospel? Let's take a closer look and see where that 20% myth actually started, what it was meant to do, and why it may not apply the way you think it does today. Because once you understand that, everything else, mortgage insurance, loan options, and how to think about your money starts to make a whole lot more sense. So let's talk about where this 20% myth even came from, because it didn't just appear out of thin air. The idea of putting 20% down goes back decades. For a long time, it was the standard way to qualify for a conventional loan. That 20% was seen as a sign to the lender that you were financially stable, low risk, and serious about the purchase. And back then, there weren't nearly as many loan programs available as there are today. You didn't have FHA, VA, USDA, or low down payment conventional options like you do now. So for a long time, if you couldn't come up with 20%, you probably just weren't buying a home. And because of that, the 20% down rule became sort of a badge of honor. Something people associated with being financially responsible, or even doing it the right way. But things have changed. Today, there are more lending options than ever, and buyers are using them. Millions of homeowners have purchased with far less than 20% down, and many of them are in strong financial positions. We're also in a very different housing market now. Home prices have gone up dramatically over the past decade. So if you're buying a $400,000 or $500,000 home, coming up with 20%, that's $80,000 to $100,000 in cash. For most people, that's just not realistic, and lenders know that. That's why loan programs have evolved. Now, just to be clear, I am not saying that putting 20% down is a bad thing. It has its benefits, and we'll talk about those in a minute. But the idea that it's the only smart way to buy a home, or that it's somehow irresponsible if you can't hit that number, that's the part we need to let go of. Because when you look at the options that exist today, and when you actually run the numbers, you'll see that the smartest move might not be 20% down at all. So let's dig into what actually happens when you do put 20% down, and why it's not always the slam dunk it's made out to be. But before we get into that, if you find this video useful, go ahead and hit that like button, subscribe to the channel, and hit that notification bell so you don't miss any future real estate, homeowner, or housing market tips. I try to put out new and helpful content every week. So what happens when you put 20% down when buying a home? Let's say you are buying a $500,000 house. If you put 20% down, that's $100,000 out of your pocket. That lowers your loan amount to $400,000, which cuts down your monthly payment. A general rule of thumb, every $10,000 you put down lowers your monthly payment by about $40 to $50 a month. So by putting down $100,000, you might save $400 to $500 a month. Plus, there's no mortgage insurance. And depending on the market, you might qualify for a better interest rate. Sounds great, right? But here's where things get interesting. What exactly is mortgage insurance? Mortgage insurance, whether it's PMI on a conventional loan or MIP on an FHA loan, isn't evil. It's just a way for lenders to reduce their risk when you put down less than 20%. With FHA loans, you'll pay mortgage insurance in two ways. First, there is an upfront fee that gets rolled into your loan. Second, there is a monthly fee, about 0.5% of the loan amount, that you pay every month, usually for the life of the loan. On a $482,500 loan, that's roughly $220 a month in mortgage insurance. And unless you refinance or put a larger amount down up front, you'll be paying that for the next 30 years. Now, with a conventional loan, mortgage insurance works a little differently. If you put 5 or 10% down, you'll still pay PMI, but it's based on your credit, your down payment amount, and your loan type. If you have great credit and a decent down payment, your PMI might be $40 to $80 a month. And the best part, PMI goes away once you've hit 20% equity. You can even request to remove it early once you hit that 20% mark. So the idea that mortgage insurance is this horrible, nasty thing to be avoided at all costs, it's just not the full story. Now let's talk about something that often gets overlooked in this whole conversation, and that's liquidity. When most people think about putting 20% down, they are focused on one thing: lower monthly mortgage payments. And yes, that's true. A bigger down payment means a smaller loan balance, which means a lower monthly mortgage payment. You're also avoiding PMI, which can save you anywhere from $50 to $200 a month depending on your situation. This is great, but here's what most people don't think about. When you put a huge chunk of your money into your house, that money is locked up. It's no longer sitting in your bank account ready to cover emergencies, home repairs, or unexpected life stuff. It's not earning interest, and it's not liquid. It is tied up in your house, and getting it back usually means one of two things: selling the home or refinancing. And neither of those are quick or free. So let's look at an example. Let's say you saved $100,000 and you are buying a $500,000 home. You could put that full 20% down and avoid PMI, which sounds like a win. But now you're left with zero in the bank. No emergency fund, no buffer, no flexibility. Let's say something breaks 2 months in. A furnace, a roof leak, a major car repair, anything. You are left scrambling to cover it. Maybe putting it on a credit card. Maybe pulling from retirement. That's not a great place to be. Now let's look at the alternative. What if you put 10% down instead, so $50,000, and kept the other $50,000 in savings? Sure, you will most likely have PMI, but if your credit's solid, that PMI might only be $50 to $80 a month. That's $500 to $1,000 a year. In return, you've got $50,000 in liquidity. That money can sit in a high-yield savings account, serve as your emergency fund, or even help you pay down higher interest debt. Let's say you lose your job, or your dog needs surgery, or you suddenly need to travel. Having that cash on hand gives you options. And that kind of financial flexibility often matters more than shaving a little bit off of your monthly mortgage payment. So yes, putting 20% down can feel safe, but keeping some of that money accessible might actually be safer. It's not just about the lowest payment. It's about setting yourself up for long-term financial stability. And that means looking beyond the monthly mortgage and thinking about the big picture. So before you drain your savings just to hit that 20% mark, ask yourself, what's the trade-off? And will I still feel financially secure once that money's gone? So does putting 20% down really get you a better interest rate? Here's another twist. Putting 20% down doesn't always get you the best interest rate. In fact, FHA loans often have lower interest rates than conventional loans, even when you're putting less down. So yeah, you're paying mortgage insurance, but your lower rate might still mean your total monthly payment is lower. And if you're strategic, you can even use the money that you would have put down to buy points and lower your rate further. There's more than one way to get a manageable monthly payment. It's not just put 20% down or bust. Here's the bottom line. Putting 20% down is not a requirement. It's not the only smart option. Sometimes it makes sense. Sometimes it doesn't. If putting 20% down wipes out your savings entirely, leaves you with no buffer, or makes you house poor, that's not a smart move. Truly smart buyers understand their budget. They keep their savings intact. They make decisions based on math, not pressure, not ego, and definitely not outdated advice. You won't get a gold star for putting 20% down if it means that you're financially stretched the minute you close on the home. The better approach? Do the math. Run the scenarios. Figure out what works best for you and your specific situation. And if you're not sure what that looks like, talk to someone who can help you weigh the options. I'd be happy to be that person if you are local to the Cleveland area, or I can connect you to someone great in your area. And if you're thinking about buying or selling a home in the Cleveland area, I would love to help you personally. Not Northeast Ohio? No problem. I have got a trusted network of experienced agents all across the country, and I'd be happy to connect you with someone great in your area. So what's your take on the 20% down payment myth? How much did you put down when you bought your home, and why did you do it? Let me know in the comments below. If you have found this video helpful, go ahead and hit that like button, subscribe to the channel, and hit that notification bell so you don't miss any future real estate tips. Thanks again for watching. I'm George Poporad, and I'll see you in the next video.